All right. Lastly, impairment. The concept of impairment, you might have seen it before. If not, it's basically a permanent write down of a value, of an asset's value. So I've used this example before. If Disney has the IP, you might not have heard this example before. It depends on which slides you viewed, if different order maybe. If Disney all of a sudden realizes that their Mickey Mouse brand is not worth as much as it used to be, well, maybe Mickey Mouse is a $1 billion intangible asset. Maybe they have to cut it in half because no one really cares about Mickey Mouse anymore. That's an example of impairment. Or maybe, your stock is valued at something, but your auditors come in and say, hey, yeah, this probably is not worth what you're saying it's worth. We need to permanently write it down. You need to recognize an impairment loss. So for the investment securities. Now, if you're looking at publicly traded stocks, you could probably see that if the stock just crashes. But maybe this is an investment in something that's not publicly traded, so you don't really have a stock crash. You need a valuation team. You might have a separate audit valuation team that comes in, says based on the cash flow, based on these factors, based on economic conditions, we don't think that this is properly valued. You need to write it down, right? You got to decrease the value of this asset on your balance sheet. Debt securities, we need to impair if the investor will not collect the debt owed. Well, that one's simple, right? If you're lending someone money and you give a bond and the person stops paying their interest and they just kind of, maybe they ghost you or maybe they just go bankrupt, well, you're going to have to impair those debt securities. And then for equity securities, impairment must consider financial condition of the company invested in to determine if the decline in fair value is permanent. So, let's say I'm investing in a theme park, an amusement park. That's a big thing in private equity because it takes a lot of money to fund those. So let's say, but all of a sudden, for example, we have a pandemic or something, and all of a sudden it's a lot less valuable. People don't want to go to amusement parks as much. So the team will come in and say, we should probably impair the investment we have in this amusement park. You have to write it down.